We are going to go over an EBITDA cash flow. This is going to take EBITDA from your financials and then layer in all the other cash considerations to ultimately determine how much cash the business actually has left over at the end of the day. So, first things first, what is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. It is a metric to basically determine what's the profitability of the entity once you take away the interest from financing, the taxes from paying taxes, the depreciation and amortization. These are your capital expenditures that you're depreciating over their useful life. And I want to clarify, I should have said this in the beginning. This cash flow statement is way more applicable to a service-based industry. If you're a manufacturer, if you're making things, this might not be a great cash flow to use. But if you're a service-based industry and you don't have a ton of capital expenditures or inventory, this is something that is very helpful. So the first thing we got to find is EBITDA. EBITDA is going to be located on the income statement, and it's going to be revenue less your operating expenses. And we're going to take EBITDA and we're going to plug it at the top of our cash flow statement. EBITDA in this situation is going to represent our cash flow, knowing that that's not a perfect metric because of accrual-based accounting, but we're going to use that as our ending operating cash flow in this instance. And this is why I caveat that service-based industries, this works pretty well for. But if you're a manufacturer or you develop a lot of capital expenditures, this might not be the best cash flow statement to use. So now that we have EBITDA, let's layer in our balance sheet uses of cash. And our first section is going to be investments and capital expenditures, aka CapEx. These are items that you're capitalizing on your balance sheet and then amortizing or depreciating over their useful life. Now that we've layered in our capital expenditures or CapEx, we now need to layer in our financing costs. And there's going to be two main categories in your financing costs. It's going to be one, it's going to be your debt. Have you taken any debt out? You've received cash from a bank or maybe some bondholders, or have you repaid back any debt back to the bank or the bondholders? Next, have you issued any stock to raise cash? Have you redeemed any stock to treasury? This is where you want to reflect that activity. This last section is going to be equity and taxes. This is going to be directly correlated to your income statement. How profitable were you during the year? Did you pay any taxes to the federal government? Did you pay any state taxes? And did you declare any dividends? These are all cash uses of the business during the year. So we need to deduct them on our cash flow statement. And so in this instance, we're layering in our state taxes from our P&L, our federal taxes from the P&L, and then any dividends that were declared and paid to the shareholder. So what does this mean? This represents the EBITDA, the cash flow the business generated from operating the business, and then also layering all the other cash uses or any other activity that generated cash for the business, like issuing stock, and determining at the end of the day for a particular year how much cash is left over. And a lot of times what's left over from a cash perspective could get paid out in bonuses, or it could be retained on the balance sheet. This is where an EBITDA cash flow could be very helpful in determining how much cash is left over from your business operating in any particular year. So hope this was helpful. I hope you got something out of it. Hope you learned something, and I will see you in the next video. Take care. Goodbye.